Get Rich Slow with John Wolf. Hey, I got several questions over the last couple days through emails about the YouTube channel. Please, I love shares, likes, comments on the YouTube. You can also email me, of course. And one of them was all about how can I improve my credit score and are condos a good investment? And I don't think I can do a video that talks about both of them, but here I'm gonna try. Okay, so are condos a good investment? Well, condos aren't my favorite investment, but there are some very substantial reasons why you would or would not want to go with a condo. Okay, so the first advantage of a condo is usually a condo, at least here in the Portland area, the purchase price of the condo is relatively low compared to similar quality homes nearby, okay? And that is directly offset with HOAs. What are HOAs? So condos almost always have homeowners associations, and the homeowners association is responsible for all of the maintenance of the grounds of the complex, as well as everything. It's called sort of studs out. So like the interior wall of the house isn't covered, but the studs actually are if it's an exterior wall. And then the outside paint, the roof, everything else. Sometimes you'll have nice clubhouses, swimming pools, things like that. And the HOA absolutely goes against your debt to income to purchase. So if you see a $300,000 home and a $300,000 condo, the actual monthly payment for the condo is gonna be more almost every time. But since you can get a higher quality dollar for dollar condo versus home, if your main restriction is, down payment, you might have enough to put 5% down on the $250,000 condo, but you wouldn't be able to put 5% down on the like $350,000 more or less equivalent home. So that could be one really great reason you'd go for a condo. Also, you might really want to go for a condo even if you're planning this as a rental property, because again, if this is your rental property, you are only going to be responsible for a very small amount of the maintenance possible as a landlord that isn't automatically taken out of the check every time. And as a landlord who might have trouble with tenants, one of the really cool things is the HOA has, conduct standards for people who live there. And if you have a renter who isn't upholding those conduct standards, they will get fines, which you'll pass on to them as the landlord, and it can eventually help you kick them out. Now, I'm not someone who really sets things up planning to kick somebody out, but it is nice to know that you have a ripcord for that parachute if you should need it. Now, let's just look at the bad side. So condos are not going to increase in value over time anywhere near as much as just a similar single family home sitting next to it. And that is because what is going to increase over time is the HOAs and the taxes almost always. And then sort of an even worse case, which is common enough that you should really be worried about it when you're looking into a condo, is HOAs go defunct. Now, what does that mean? Well, that means that the homeowners association, which if you buy in, you are a member of, a voting member, but they determine how the money of the HOA fees is distributed, who gets paid, what work gets done, and sometimes that gets, this is sort of a microcosm of government, sometimes it gets horribly mismanaged. And there will be a roof that needs to get replaced 30 years down the road. And even though you've been paying $400 a month to the HOA since forever, somehow they don't have enough money to pay for that roof. Now that's because they've been mismanaging money for many, many years. But at that point, they're going to do what's called a special assessment, which means this is a special time when they need 5,000 of your dollars or whatever the dollar amount is to get the job done. And I have read into a bunch of those because every once in a while clients see very cheap condos and they want to know if they should buy into it. And I found out that the condo is non-warrantable. That's a lending thing, but that basically means Fannie Mae, Freddie Mac, or FHA or the VA have gone through the profit and loss statements or the books of the credit union the HOA, and they've basically figured out that this HOA is essentially bankrupt. The HOA doesn't have enough assets to pay for its likely liabilities right now or in the future. That is why it's not a requirement, but if you are looking at condos, it's a huge gold star good thing to see if the condo is either FHA or VA approved. And the easiest way to look that up is you can just like Google FHA warrantable condo, and you'll get this search tool for the HUD and put in the zip code and then look for the name of your complex. That's the easiest way to tell. And if it's HOA or if it's FHA approved, it's almost always VA approved. And the lookup tool is just a little more complicated. But anyways, so that's sort of the pros and cons of an of a condo. So in a condo, you're responsible for a smaller buy-in, but that's replaced by a monthly amount that you're gonna owe, and you are not gonna have the increase in value over time, but you're gonna have less maintenance costs, theoretically, to deal with. Also, a little bit of help on management if you're going to be renting that place. Now, are condos a terrible death trap you can never get out of? No. Are they the most attractive investment for increase in value? No. Are they the most attractive investment for cash flow if you're renting? No. If you want to live there and just live a simple life, is it a totally okay, good thing to do? Yeah. My mom lived in a condo for many years. It had, it was like gated, and there was actually a clubhouse where there was someone there to receive packages all the time, and they had a nice pool. I actually had my wedding there. It was great. Anyways, now the second question is, somebody asked me, and just a little bit of background, this person just had a mid-600s credit score. At least that's what they thought. And they asked me, how do I get it to that like sweet 760? And the fact that he asked me about 760 tells me that he's either very well informed about home loans in general or has been watching my channel. Because for most things, 760 is a perfect score as far as home loans are concerned. Changes a little bit up in jumbo land, but conforming, 760 is a perfect score. Don't need to shoot higher than that. So anyways, how do you do it? So if you have a mid-600 credit scores, it's for one or two or combination therein reasons. So either you have some old lates, or you have credit cards revolving balances that the percentage between the maximum allowable balance and what you owe is high, or you just are new to credit. Those are kind of the only reasons, because if you starting from nowhere and you just get an installment loan like a car or something, and you get a credit card, you're very quickly going to go from no score to bad score to low 700s very quickly if nothing else happens. So some things that you should and should not do if you're planning on getting your credit run by me for a home loan in the next couple months. So first of all, do not pay collections. And I mean old ones. I'm not saying don't pay debts that you owe, but do not pay collections with the expectations that your credit score is going to get better. It's going to get worse or stay the same 90% of the time. And you really need an expert like me to look into your individual situation just to see if it's not. The other thing you should do, and this is the one that's more something you can do 2 weeks before you call me if you want to, is your credit card balances. If you have it's the percentage is the only thing that matters, and it's the percentage of each individual card and the string of percentages overall. So what I mean by the percentage is so if a credit card has a maximum balance of, let's just say $100, and you owe $1, then your utilization percentage of that credit card is 1%. If you owe $100, then it's 100%. So a generic person who has relatively new credit, like they have 3 credit cards that are a year and a half old and there's nothing else, each one, the percentages on each one of those cards, the way it's going to affect your credit score is something like the following. Not exactly, but if you have a credit card and you owe 0 on it, it's worth about positive 20 points. If you have a credit card and you owe $1, it's worth positive about 22 points. Yes, that's better. Once you get past owing 20% on that card, it starts to go down. So when you get to about 25, 30, it's worth 0 points. You got rid of all the positive points. Once you owe about 50%, it's worth about negative 10 points. Once you get up to 100, it's worth negative 20 to 40 points. So it is very possible that in just 1 month, from just paying down your credit cards, you could have your credit score swing from 660 to 760 in a couple weeks. Now, that's not universally true. I have a tool that actually lets me predict outcomes very accurately just for you to show you where to use your money. And also those percentage break-even points are kind of fuzzy. They're not the same every time. But anyways, you can jump in there and you can improve your credit by keeping balances down. Now, other than just keeping those balances down, what you can do is decrease the total utilization by increasing the maximum credit limit. So for example, I just got an Amazon card and it like automatically approved me for $1,000. But since I'm buying fancy cameras and stuff and I need my credit score to stay good, I called them and I asked them to make it $25,000. For some reason, they decided that $7,000 was a good answer. That'll work because on a normal month, we're probably not going to spend more than $2,000 as my household on Amazon. But anyways, that's the kind of thing you need to look at. If you are a contractor or something like that, where you might spend personally $300,000 in 1 month and pay it off and again and again and again, like some of the contractors I know, then you want to look into two things, because you're not going to be able to get a normal credit card that will let you do that without constantly tanking your credit score, because they might give you a $100,000 credit card, but you're going to charge that thing up entirely in one single month. So what you should do is you should get one of those American Express like cash cards that you have to pay off every 30 days. That doesn't affect your credit score the same way. And then as you continue to do business, you could actually see about getting a business credit line, which is not a credit card. I mean, like at US Bank, they'll give you like $1 million credit line. It's complicated. That's not a kind of lending I do, but it's something you might want to look into. Anyways, the next and sort of last quick thing I can tell you to increase your credit score is if you just don't have a lot of credit, or you have a little bit of bad history or no credit at all, if somebody makes you the authorized user on their credit card, so long as it's been around for a while, like at least a year, never been late, doesn't have much or any balance on it, then you actually get all of that positive credit history instantly. So just the most extreme example of that, and I know I've told this story before, is a very, very close friend of mine. Grandma made them the authorized user on, I think it was a Texaco card that was opened in 1949. There were credit accounts back then. They weren't credit cards though. And that was the only thing on their credit. And so they were at 800 something credit score. And that was an 800 something credit score for mortgages, even better for cars and stuff. So anyways, please, if you thought this was useful, like, share, and subscribe. Have an awesome day. Bye.